everybody to this event in the Law, Finance and Technology series. It's a great pleasure to welcome Heather Hughes. Professor Hughes is a professor of law at the American University Washington College of Law, and she is a specialist in all aspects of commercial and property law. More recently, she's doing lots of research in financial transactions and blockchain technology, and this is what really makes her interesting for us. And she has a fascinating project on financial technology and financial inclusion. So an interesting aspect that came through in some of the other events that we were running, but we'd look forward to hearing from the expert. Heather has agreed to speak in a much conversational tone, so you are very much encouraged to come in and ask questions as she goes. And there's lots of time for comments or questions during the talk, and afterwards we have 1 hour in total. That's it from me. Over to you, Heather. Thanks so much for being here with us today.
Thank you so much for having me. It is such an interesting conversation that is going on right now surrounding financial technology and expanding access, to banking services, various forms of financial inclusion. So thank you for having me join your piece of the larger dialogue. So there are two different conversations going on, at least two. There are many, but I am thinking about two different conversations going on surrounding blockchain-based market activity. And one seems to center on financial inclusion and the way that financial technologies can expand access to financial services and access to capital, as well. And in that conversation, the regulatory concerns surround investor protection largely. There's a second conversation going on that is about blockchain-based market activity and systemic risk. The fact that blockchain-based market activity can increase the complexity and speed of financial claims. The fact that blockchain-based market activity can operate in a way that is somewhat detached from underlying legal norms. And the regulatory concerns in that conversation are systemic risk concerns. As we know, conversations about investor protection and regulation of investor protection is often a field apart, from systemic risk regulation. But, I have been writing for the past few years on blockchain-based market activity and the private law, meaning the US contract and property and commercial laws, the state level US contract and property commercial laws that underscore financial market activity. And I was invited to participate in a symposium for the Journal of Law and Contemporary Problems, and the theme was inclusion, financial inclusion. And that's when I started to think that these two conversations are related in multiple ways. If we don't get the systemic risk part right, if we don't successfully address the systemic risk concerns that blockchain-based financial markets present, then that affects financial inclusion. So in a sense, this point is a very broad one. If we have excessive systemic risk and instability, that has distributional consequences, and those distributional consequences undermine gains that we might otherwise associate with financial inclusion surrounding these platforms. So when I started to think about how that's the case, obviously I am drawing from the experience of the 2007-8 financial crisis and the resulting housing crisis. And there's some very interesting parallels. There are some very close parallels in the sense that at that time, there are established narratives about policies and practices that were aimed at financial inclusion, but then ultimately had the opposite effect when you had system-wide failure. So the expansion of mortgage products, the proliferation of different types of mortgage products, which were very explicitly permitted to expand access to housing, among parts of the demographics that did not have adequate access to the housing market. And in a way, in theory, that should have been successful. I mean, even the highest risk mortgage product confers the rights of a debtor in foreclosure, which is superior to the legal status of being a tenant in a sale leaseback arrangement or installment sale, where you may have no legal claim to equity that you feel you had built, over the course of performance on that financial transaction. So the housing crisis, of course, then undermined the longer lasting gains that may have followed, from those types of transactions. So now fast forward, there are transactions like algorithmic based lending platforms that have great financial inclusion potential. I mean, loan underwriting that can accommodate factors beyond just income and credit score that are perhaps more precise and can make capital available to people who were not otherwise getting loans on decent terms using traditional underwriting methods. Those loans, those AI-based loans, rely on secondary markets for their funding, much like the innovative mortgage products of some years ago. And so, there are some direct parallels like that. If you have an expanding market of algorithmically underwritten loans, and that is dependent upon secondary markets for its stability and funding, and then there is systemic risk that can undermine the value of the securities backed by those loans, what ultimately happens to the borrowers. So there are some very close parallels that people are thinking about. My work, though, is takes a little bit broader view than that. I'm not talking just about actual financial products that are FinTech driven that contribute to systemic risk. I'm talking about blockchain-based market activity writ large, like the fact that financial markets are migrating onto blockchain-based platforms and distributed ledger platforms, and what that means for systemic risk. There are two different ways that this development threatens systemic risk. One is just the capacity for increased complexity and speed of claims. And other scholars have written about this, and markets has shifted from the primary market to secondary markets. And then the increasing speed and complexity of secondary market activity and how difficult it can be for financial regulators to keep abreast of.
Your internet connection was a bit weak.
Oh, I apologize. Is it better now?
I think I can hear you better now, yeah. Is it the same for everybody? Okay, so maybe you go just back a few seconds. What we were just saying.
Sure. So I was saying that the migration generally of the center of gravity in markets from primary market transactions to secondary markets presents regulatory challenges. And a blockchain-based financial activity is poised to greatly expand the speed and complexity of secondary market claims. So that is one regulatory challenge, that blockchain-based financial activity presents at the systemic level. I have been publishing in recent years about a second challenge that this activity presents, which is that lawmakers treat blockchain-based smart contracts for financial transactions as just the same type of transaction we all know, a securities repurchase agreement, an asset tokenization, whatever it may be, just migrated onto this new platform. But the platform itself has a legal effect. And that legal effect, asset partitioning, makes it difficult to simply fit existing transaction types into the new space. So what I'm talking about is the fact that blockchain-based smart contracts are self-executing. They automatically capture assets to satisfy claims, embedded in code on the platform. So you can translate any existing financial transaction into code these days and express it in a smart contract form. However, lawmakers are not quite digesting the reality that once you do that, the platform removes the legal intervention point at which you make a characterization challenge. The point at which you would determine in off-chain transactions the nature of a deal for regulatory purposes. So many financial transactions involve legal ambiguity, right? And they involve ambiguity on purpose. The claim is more valuable if the parties do not nail down in advance if it is a sale or a loan, for example. The securities repurchase market, is one example of that. All of equipment leasing is an example of that. Many asset securitizations are an example of that. Everybody understands that there is characterization risk in the deal. That characterization risk is only relevant in the event of a bankruptcy or in the event of a regulatory challenge, that involves classification of the transaction. So another way of saying the same thing is that the administration of private law rules depends upon these legal intervention points. A classic legal intervention point, of course, is the automatic stay in bankruptcy. So if a company, an originator of assets in a securitization files for bankruptcy, the automatic stay then captures all of the assets of that originator and creates an opportunity for that originator to claim a property interest in securitized assets. The purchasers of asset-backed securities may contest that, but that's where the characterization analysis happens. Now, blockchain-based smart contracts obviate that intervention point. So they leave the originator, for example, in that context, in a remedial posture. So from a legal standpoint, the self-executing feature of the blockchain-based transaction may violate the automatic stay. But what is anybody going to do about it? If the platform automatically transfers assets to investors upon the occurrence of an originator bankruptcy, then that leaves the originator's creditors in a very different position, than if they had the capacity to continue to use and access assets through the bankruptcy process pending a a legal determination of their status. So that's just one example of the disconnect between legal status and practical reality that blockchain-based financial markets presents. This detachment of practical realities from legal standing is a systemic risk problem. Again, if we look back to 2007, 8, that period of time, you can think about the difficulty that many purchasers of asset-backed securities had difficulty establishing the underlying legal status of their claims in foreclosure. For a second example, the legal foundations of securitization itself, of the creation of asset-backed securities themselves, was uncertain for years, and people knew it. Some states passed what we call asset-backed facilitation, asset-backed facilities acts, statutes that just deemed any assignment of assets for purposes of securitization to be a sale, regardless of the level of recourse in the deal, just because it was clear, and would give investors a clear basis in the asset. In the repo market, the US Congress added a provision to the bankruptcy code to accept repo claims from the automatic stay, if the underlying deal simply stated that the repo transaction was a sale and repurchase of securities as opposed to margin trading, an extension of credit collateralized by securities. So again, the sale loan distinction is integral. And scholars have written about the fact that that legal exception, that departure in the legal treatment of repos enabled a run on the banks, because you could exercise a call and dispose of the underlying securities without having to justify the valuation or method or timing of sale, like you would if you were actually margin trading. So we know from experience that when you have a departure of market dominant financial transactions from their legal grounding, that uncertain legal foundations present systemic risk problems. So the blockchain-based financial markets, again, are really poised to aggravate this type of problem, because you have a market that uses a mechanism with a legal effect. That effect is asset partitioning. When you think about the basic legal structure of financial activity, it depends on contracts. It depends on assignments of property interests, whether they're ownership interests or liens or whatever they are. It depends on the use of business entities, the use of structure, the formation of special purpose entities, which is a method of isolating assets from the claims of shareholders' creditors. It's what limited liability is. The assignment and the entity are both methods of asset partitioning. Blockchain-based smart contracts accomplish asset partitioning because they automatically convey assets to investors. They're automatically enforcing. They're self-executed. But it's not always clear whether that mechanism is consistent with an assignment or an entity. And if it is consistent with an assignment, is it an assignment of a lien or of an outright property interest, of an outright ownership interest? We don't know. What happens, for example, if code is written to not recognize the claims of an assignor's creditors? Does that fact make the transaction a structured transaction, that involves the functional equivalent of an entity? Or is it just a logistical impediment to the enforcement of creditors' rights in a lien transaction? It remains to be seen. So I'll stop there. My point is simply that these private law issues contribute to systemic risk, and excessive systemic risk will ultimately threaten financial inclusion. So these two narratives about blockchain-based market activity, that they have great potential for financial inclusion, but they also present systemic risk, they're related.
Thank you very much, Heather. That was very, very thoughtful and gave us a lot to think about and I guess to discuss. Well, before I ask something, let me just open the discussion for everybody now. It would be great if you could use the raise hand function or the chat function if you would like to comment or question or challenge some of the points. But let me first of all put something directly to you. So you basically made the detour, if I want to say it, through going through the systemic risk argument, right? And then making the pointing out the implications of systemic risk to inclusion. I'm wondering if there is another, maybe a more direct connection between the two fields in the sense of, I mean, financial technology and blockchain technology are frequently credited for, for providing finance to the unbanked, to those who are not part of the traditional financial system, who typically rely on the traditional institutions like banks and other intermediaries before. And so the promise and the hope is that, if we move away those intermediaries, then we have a much more accessible way of reaching finance. And do you think that argument is valid? And how does it relate to your claim, the sort of financial risk argument? I'd love to have your views on that.
I do think that claim is valid. And I think there is tremendous potential for financial inclusion gains, with these platforms, especially from a global perspective. So my work is simply making the point that when we think about blockchain and financial inclusion, we cannot focus exclusively on that aspect, of these developments. We have to keep the systemic risk component in mind as well.
Okay, sure. No, absolutely. That's no question. It's just the question: which is stronger? Is it sort of the or cost-benefit analysis? What is more problematic? But probably very hard to predict, right? I guess.
The answer to that may be very different in different regions, in different parts of the world. I'm thinking primarily of the context in the United States. Where people are very excited about new banking platforms and new algorithmic underwriting and expansion of access to credit. And then, of course, the experience in the United States, of the housing crisis and the distributional fallout of that. Now, if we're talking about a different part of the world where there is much less access to financial services than there is here, even among the poorest, of the population here, calculus might be different.
Yeah.
Access to banking services, more stable money than perhaps the local fiat currencies provide. You might have a different perspective.
Right. Thank you very much. So I have questions here from Pedro, first of all.
Thank you, Professor Hughes, for the talk. I have a few different questions, but I will start with one, and then maybe if we have time, I come back to a few others. So the first one is, I just want to push you back a little bit and then get to see your reaction on one of the assumptions. So you say that one big issues, the two big issues that we have with the blockchain-based finance is one that's increased complexity and speedness, and the other one is the self-executing nature. And on the first one that I was a bit more curious, yes, it is a mechanism that allows a quite diverse way of dealing with certain transactions and building new forms of governance even. But one of the selling points of the technology is that it also increases transparency. So I was thinking about that. Complexity in itself, it's an issue. It's an issue because it creates a fogness and it limits our capacity of understanding what's taking place. But if that complexity is enhanced, but somehow it's done in a way that we can still track the chain of events, maybe the complexity itself won't be an issue. So I was curious on that point, if you see that it also might be some gains on the blockchain-based finance on the increasing transparency part. Also because you kind of point that the way we do finance today, transactions are intentionally, how is the expression they use, ambiguous. There is a positive side on that, but it also creates a complexity, the ambiguity of financial transactions creates an element of discretion that is hard to evaluate. So I was thinking like, oh, maybe there is a gain in transparency that might compensate the costs of complexity.
That is a great question and point. And I want to talk about it in two ways. One, complexity and systemic risk very briefly, but then two, where I think things are going in the markets to take advantage of the potential for increased transparency. So just briefly, it's interesting. Many scholars have written, as I'm sure you know, about the relationship between just complexity itself of complexity of a particular transaction or the transactions in a particular market and systemic risk, right? And in theory, why would complexity itself be a risk concern? But when you think about the fact that complexity and opacity together make claims difficult to value and therefore can contribute to value in a market in which values are rising, but then can be very difficult and create liquidity problems, when the market is not appreciating. So there's been plenty written about the relationship between complexity of transactions in a market and systemic risk. And you're correct that I am riding on that assumption. I am riding on that scholarship and prior work. I published on it myself some years back as part of a wave of people, who were writing after 2010 about complexity and systemic risk. So yes, that piece is in there. Now, you make the point that the blockchain-based financial transactions present opportunities for transparency. This is really interesting, and there's a lot of interesting stuff out there on automated compliance, for example. And so far, the automated compliance is focused on bright line rules embedded in regulatory structures. Like you can now have issuances that automatically comply with know your customer rules, or that embed automated compliance mechanisms for securities regulations. For example, if an issuance can only be made to accredited investors, or whatever. But automated compliance and transparency presents challenges. It's harder to get to the automation of compliance with the underlying private law doctrines, like the true sale doctrine. And I'm actually working on a project about this right now. To what extent can you have transparency for compliance with underlying legal norms, not just regulatory rules that are bright line rules that you can see how you would code them in. Now, take the example of, again, the asset-backed facilitation acts, the ones that just say, we don't care how much recourse the investors have back to the company that created the assets if the securities don't perform. We don't care. We're just going to call it a sale. We're just going to override the whole concept, of a sale loan analysis and deem this to be a sale. This is like a statute that says all cats are dogs. I mean, it's like for legal purposes in this jurisdiction, all cats are dogs. We don't care if it meows and wants tuna. It's a dog. It's a legal dog. That is problematic in many ways. And I've written about it. It's so problematic because you're basically potentially cutting value away, from huge classes of creditors without justification, in traditional legal terms. However, it's clear. It's codable. So if lawmakers have already been willing, to take steps like that, even in advance of these blockchain-based markets, perhaps it might not be a bad thing if we go for codable clarity in private law terms. And then if we don't like that policy choice, we can think about what is the clear regulatory mechanism that offsets that distributional consequence. Like you could also have, for example, a bright line rule that only permits assignment in that type of transaction of up to 80% of value, of the company. You could have a mandatory equity carve out, to preserve some value for the creditors that have positions jeopardized, by this. So in short, right now, we just have financial markets migrating onto distributed ledger platforms with complex deal structures being translated into code. There's not necessarily increased transparency with respect to the underlying legal status of the deal. In fact, you could say that the self-executing nature of the platform increases opacity, because you have less incentive even to determine, to bring the legal claims to determine the status that then sets the precedent for the market dominant forms of transaction in the marketplace. But at the same time, you do have the potential to code for greater clarity. That will require a cooperation between lawmakers and the coders and the market actors. And that's where I think it gets really interesting. There's a group at Stanford, CodeX, and they do all kinds of series and lunchtime series and talks. And they have speakers on all the time who are working at this forefront of law and code. And when you step back and think about what laws are codable and what laws are not, I mean, perhaps the civil law jurisdictions will have a great advantage because the common law standards are really difficult to codify. And yet that may be where we're going, because in a sense, perhaps even though the distributional effects are atrocious, maybe a clear codified true sale doctrine then gives policymakers the opportunity to say, okay, that's how we're going to roll. How do we protect originators, creditors, and bankruptcy? What is the offset to that? As opposed to just relying on these underlying private law doctrines that require a lot of standards, precedents, analysis, things that are just not really amenable to administration in a blockchain-based market with self-executing deals.
can I keep on just push back on one point? Because you also brought this issue that the blockchain-based finance gets a bit more complex, the partitioning between contract rights and property rights. So it gets a little bit confused. And you brought us the case of bankruptcy as an example to kind of visualize that. But then what I was also thinking on, maybe not necessarily that is brought by blockchain, but maybe by other technologies that are enabling the FinTech movement that we have today, is the gain in speed. So you also pointed that speedness might be a problem. But thinking about bankruptcy and me being a student of bank crisis management, like trying to solve the claims in a weekend. So like this debate on like how fast you can solve a bankruptcy of a bank and so on. There are multiple gains that you can have from the speed that you can bring to these procedures. So I was thinking also on that part, maybe.
That is a fascinating perspective development as well. You know, the actual administration of legal claims using code, you know, and using these platforms. In fact, I won't get into this, but it invokes a very interesting conversation going on right now about what is the unauthorized practice of law. You know, the legal profession is heavily regulated to protect, you know, its professional expertise. But you're correct. I mean, what are the prospects for more transparent and rapid resolution of claims using coded platforms? You know, so yes, there's so much going on in that space. It's really interesting, and it remains to be seen if algorithmic governance will get that far, you know, and we will accept it.
So we already have topics for the next talk. I see it. Pedro, you fine? Did you have anything else that you wanted to ask? Or?
Maybe pass the word to Alessio, but I have a last point that I'll bring back.
Sure. But let's give the word to Alessio.
Thanks, and thanks, Professor, for your presentation. I have one question that may help me clarifying your argument in my mind. Are you mainly concerned with the technological aspect, how the blockchain technology function, and so what can be the possible failures in recognizing by the technology the functioning of the law, apply it safely and comply with that? Or there might also be another dimension that can be a source of systemic risk. Like we all expect the blockchain project to shape the landscape of market actors as well. In particular, for example, may disintermediate those middlemen like central counterparties and other fundamental market infrastructures. Also, if I look at the biggest blockchain project now going on, there are always often a pool of big actors that try to produce new platform in the financial world. And so I really see also a law of privates that is emerging against the law of the legal system itself. Can you let me understand more on this last aspect,
yes,
please?
that is a great point and issue as well. So when we think about blockchain-based markets and intermediation, people often think first about the cryptocurrencies, you know, and the capacity to sidestep government-issued currency or fiat currency in order to create markets alternative, you know, potentially to law or to the laws of any one jurisdiction. But there's a whole second level of conversation that is more germane here, which is just the relationship between these markets and intermediation as we know it. So one of the hot topics in the US, in the Uniform Law Commission and commercial law field is intermediation and securities entitlements, you know, and securities. You know, the financial system relies on all kinds of intermediaries. And some states and some lawmakers are very keen on preserving intermediation, for various reasons. And others are very keen on letting the system depart from requirements surrounding intermediation. And that concept and the future of intermediation in markets, I think is central to the conversation about how these markets are going to evolve. Another way to think about it is to say, if the state governments here, and whatever the corresponding governments are, general governments, around the world, recognize complex financial markets in the absence of traditional intermediaries, if there is commercial law reform, securities law reform, the underlying law reform, to recognize those claims in the absence of intermediation, then you have blockchain-based markets functioning in accord, with all of these various legal systems, with the legal architecture of markets. On the other hand, if the jurisdictions decide to preserve requirements, of intermediation, then you have the potential for some blockchain-based markets will comply and will structure themselves to be in compliance with laws, that require intermediation, and some will not, and which of those markets will ultimately, command more value, and how will people participate in those markets, and do they then present two distinct regulatory concerns, or, is it still, one system? How do you think about that? I think that is a huge question right now.
Thanks. Pedro, you had another question, I think?
Professor Hughes, I think I muted you by mistake. Yes, perfect. No, I had another one that was a curiosity about a point that Professor Ringe and I make in a forthcoming paper that's coming on next month at the Stanford Journal, which you also have your blockchain paper published on. In one argument that we make, we are talking about the use of new technologies for regulation and supervision and compliance, but we made a short point on blockchain itself, because you told us about a lot of the problematics of adopting this technology, and a lot of the benefits are still to be seen. It's a lot of promises on the potential that this technology will bring, and so on and so forth, and we are talking about the implementation of this technology of blockchain itself on the structure of supervision and regulation. So you are embedded at, you're talking now about intermediaries, and I was also thinking about how new players are promoting this technology and selling to sometimes regulators that is not, they are not completely aware of the benefits that they're going to bring, if those benefits are going to be really, materialized. So they might end up engaging with a technology which doesn't bring the benefits or turns to be obsolete too fast. And as you pointed, it's a technology which seems to be kind of complex to get out, to because you are in the self-executing world, and then to move up after that, it seems to be hard to take place. So I was curious just on this element of this asymmetry of information, of a lot of people promoting the information, and some people that are buying into it are not really able to evaluate the benefits or not, and be able to get out and then move on.
I look forward to reading that paper. Yes, it's a very important point. And there is so much asymmetry of information. It's really difficult to keep abreast of what is possible, in terms of even just coding itself. things seem to happen so fast. I mean, you can now code in English with Lexon, you know, and yet it's really difficult to keep a pace, you know, of the platforms and what they are doing. And lawmakers, I think, are in very different positions. I mean, different states are at different levels of interest. And then within any given state legislature, there's widely different, you know, levels of understanding and interest. There's just so much inconsistency surrounding the use of the term blockchain, and so much inconsistency surrounding the use of words describing different cryptocurrencies, tokens, tokenized assets. There is not a settled set of definitions for lawmakers to work with, you know, which aggravates this issue. So yeah, I very much look forward to reading your paper. That's it sounds like a project that is really crucial right now.
Thank you. I've copied the link in the chat for everybody who wants to have a look. But now I give the word to Alperen.
Yes, thank you. I think my question relates to Pedro's point on transparency, maybe related to it. I wanted to ask about whether you would also think that these blockchain-based platforms would also help alleviating the systemic risk rather than increasing, reducing the systemic risk, because in 2008, a lot of panicking resulted from the uncertainty in the market. You didn't know how much exposure you had, for example, to Lehman Brothers or other investment banks. You made margin calls, but it was disputed. You didn't know how much money you would get. So maybe your trades or derivatives are based on blockchain based platforms, and they are self-executing. So you know how much or to what extent your exposure is to your counterparties and how much you are going to get. You know who is going down or who is going to be able to pay you. So this certainty and self-executing can also be a point that reduces actually the systemic risk rather than increasing. Do you think this is a valid point? Or so? Thank you.
I do think it's a valid point. Yes, the capacity of investors to know, you know, that a margin call will be satisfied regardless of the, you know, underlying status of the claim does introduce certainty that perhaps can stabilize markets to a certain extent. The systemic risk due to uncertain legal foundations comes into play more in really falling markets. You know, when you have financial downturn, and then what happens when you have challenges, you know, from parties who say no, you know, and in a system that is distributed ledger based, people could say, all right, you may have coded that to say that, you know, it was a securities repurchase agreement and you just disposed of all the securities in accordance with the terms of that agreement, but it was margin trading, you know, and we have a claim to, you know, some of those assets. And then what do? You know, are those people simply cut out of the market? And what kind of risk does that present? So in traditional markets or off-chain markets, contracts are written using language that very plainly, you know, will call everything a sale, you know, and it's only at the point of intervention, you know, of legal challenge that you realize it's not a repo, it's a margin agreement. So I take your point, you know, that clarity in and of itself can introduce some stability, you know, but it sits alongside the point that uncertain legal foundations ultimately, you know, can be very problematic.
Okay, great. Then we have a question from Marco.
Hi, Heather. Thank you so much for this presentation. I don't know if my intervention is rather a question or a comment. In the last few months, I've been working on complexity. And whenever I read any paper talking about complexity, especially in the US, I'm kind of lost, very honestly. I give you 3 examples. Denore talks about complexity in the sense of interconnection of financial markets. Kate Judge, in one of her first papers, one of the first articles on Stanford Law Review, she was describing derivatives and talking about complexity. And then Stephen Schwartz talks about complexity, describing these different layers characterizing financial instruments. So these are very different ideas of complexity. My perception is that this is a rather misuse of the term complexity, because here we're talking about something that is complicated, not complex, because complex has roots, it has scientific roots that none of these authors tends to develop. Except for Schwartz, that mentions complexity science in one of his footnotes. Now, blockchain comes with a lot of confusion, as you said. Cryptocurrency, we don't know what is a cryptocurrency, we don't know what is a smart contract. We have difficulties in interpreting Article 9 from the commercial code. But complexity also comes with a lot of confusion. So when we are trying to mix the 2 aspects, probably we really need to make some clarity, first of all, in relation to what is complexity. And then once we have a clear idea of complexity, what do we really mean? We can probably mix the 2 and say how blockchain reduces complexity. Otherwise, there is more complexity generated by this approach. So from this perspective, sorry for being too long, what's your idea of complexity here? And how this increased transparency is functional or is not functional to increase or decrease your idea of complexity? Thank you so much.
That's a really excellent point. And I would answer your question at the end to say that really, my own work concerns legal complexity and the fact that complex common law doctrines generate value in markets. And the doctrines are complex for a reason. They're complex because it enables market actors to create value if they can structure ambiguity, if they can engineer certain levels of ambiguity into their conveyances. What happens to that, what happens to those transactions once you no longer have the capacity to administer a complex legal regime, because the market actors are left only in remedial postures and the legal intervention points are gone. So that, in my own work, is the complexity at issue. The complexity in the administration of the contract, property, and entity laws, that the market relies on. As you point out, there are different approaches to complexity, and the complexity and systemic risk conversation does seem to be about the sheer complexity of these deals, these financial claims, meaning, that they're based in quantitative methods, and, in a blockchain-based market, they may be algorithmically determined, and that's complicated. But you're right, it's complicated. It's not necessarily complex, and it's not necessarily problematic. You have to draw some lines there, to get to the relationship between complexity per se and systemic risk. And complicated systems perhaps can be more stable or introduce more value. You know, that there are assumptions here that you know, that we would really need to explore. And it sounds like your work is doing that. So it's a very good point. Thank you.
Thank you.
I'm sure it's going to be a very complex article, Marco, but thanks so much for that question. And just looking around, are there any other questions to the speaker? Pedro, yes?
If I may, I'll just come back again. Just because of our parents' question, I thought was fascinating, and I was curious a little bit about that, because one of the arguments and one of the beauties, like, of the legal framework of what law can do, is that it can bend contracts. No? So, especially like during a moment of crisis where you have an unknown event happening, you want to be able to suspend the enforceability of some contracts here and there, so you can have a better management of the crisis that is taking place. So like on a counter to Ampare's point on the benefits that blockchain might bring, you have Professor Pisto make this claim over time and time again on saying that what law can bring is exactly that it can reshift the contract, the liabilities in general that are taking place. So you can like have a new perspective on what are the situations of the institutions, and then move things around, who's going to be the priority now and then, who we are able to come back to. And then what you are pointing us is that blockchain will get in the way of law being able to do that, also, like to be able to suspend the enforceability of contracts, which is a good thing to have during a moment of crisis. And also think about the pandemic today. It's a good mechanism to have if it's needed. Like business that are in bad situations are not being able, and then instead of like being forced to comply with a contract that they signed in good times, they are now able to go to the law and then get a better deal.
Mm-hmm. Yes, that's another way of putting it. You know, what happens in these blockchain-enabled markets of the capacity to suspend performance. And suspending performance is crucial to the administration of a number of different regulatory regimes. I mean, suspending performance can be integral to tax. It's necessary to administer foreclosure. You know, bankruptcy we've already mentioned. And, you know, you bring in the possibility of simply suspended performance due to changed conditions, and that there may be contexts in which you want to permit efficient breach, you know, and what happens to that concept in these markets. So yes, that's very interesting.
So it ultimately comes back to the starting point, basically the element of flexibility, I guess, right? Which your talk and your piece has really centered around. But I think, cautious of time, I'd like to draw this conversation to an end. I mean, I really learned a lot. It was really eye-opening, and I'm sure that we all had great insights into your work and your scholarship. It was wonderful to have you with us here, and you gave us some very thought-provoking ideas. So thanks so much for taking the time. And
thank you so much. I loved these questions. I learned a lot too. It's great. I've got a lot more definitional work and more content to add.
Perfect. That's how scholarship should be. But thanks so much. And thanks everybody for joining. I hope we see you next time. Thanks and have a good day, everybody.
Thank you.
Thank you very much.